Nvidia just crushed earnings again, but here's the part no one wants to talk about. A beat like this can still be the beginning of a major market problem. And if you're retired or close to it, this matters more than ever. Yes, Nvidia delivered another monster quarter. Yes, the revenue growth was huge. Yes, demand is still outpacing supply by double digits, but when one company becomes nearly 9% of the S&P 500 and 7 companies represent almost 40% of the entire index, a blowout earnings report doesn't remove risk, it concentrates it. This is exactly how fragility builds. We've seen this movie before. Back in 1999 and early 2000s, Cisco dominated routers the way Nvidia dominates AI chips today. 80% market share, essential to the early internet, untouchable until suddenly it wasn't. Nvidia is now sitting in the same position. Incredible dominance, incredible demand, incredible dependency from the entire market. A beat today does not guarantee smooth sailing tomorrow. In fact, it often marks the moment expectations become so high that even excellent isn't enough anymore. Nvidia's numbers were already expected to be huge. Analysts baked in 40 to 50% revenue growth trajectory. The stock price baked in even more. So even when Nvidia crushes earnings, Wall Street immediate asks, is this the peak? Is demand softening? Is the 12-to-1 demand ratio starting to normalize? Is supply catching up? And what does that mean for future margins? Markets don't react to what happened, they react to what happens next. A blowout quarter raises the bar even higher and increases downside risk if anything cools even slightly. And here's the real problem. Nvidia is strong because everything else is weak. Consumer credit debt is at $1.25 trillion. Car repossessions are at the highest level since 2009, especially among prime borrowers ages 30 to 39. Mortgage refi denials, highest since tracking began. The S&P is up double digits, but remove the Magnificent Seven and the story changes dramatically. We are in a labor recession, even if the stock market doesn't feel like it. Nvidia's success is masking broader economic stress, and that can't last forever. If you're 55 or older, this is the moment to reassess. Are you overly dependent on mega cap tech? Are you exposed to concentrated index funds? Are you assuming that Nvidia's growth is the same as economic growth? Because it isn't. Nvidia's beat is great news, but it doesn't change the underlying risks. Stretched consumers, rising delinquencies, slowing hiring, and a top-heavy market riding on the shoulder of the small group of companies. When the foundation beneath those companies is shaky, even great earnings can't hold up the market forever. This is the moment. Reduce concentration risk, rebalance towards durable income, protect the next 10 years of cash needs, separate your retirement plan from Wall Street's hype cycle. The AI revolution is real, but markets don't move on technology, they move on expectations. And Nvidia just raised expectations again. If you want a clear, personalized plan to navigate this environment, especially your exposure to the Magnificent Seven, use the link below to schedule a free 15-minute consultation. Because in a market like this, you need to know when to play offense and when to play defense. I expect the market can be strong during 26, 27, 28, but the all-time highs we're seeing today won't last forever. The investors who win are the ones who prepare before the adjustment, not after. And if you want to understand exactly how mega cap tech is distorting today's market, reach out to us. I'd love to have a 15-minute conversation with you. When a spouse dies, you lose a partner, you lose a Social Security check, but here's what the IRS doesn't tell you. You lose your tax bracket too. It's called the widow's penalty, and in 2025, it's going to hit harder than ever. Most couples plan for retirement assuming they will both be there, but statistics tell us one of you will be left behind to manage the money alone. Let me show you a real example. A couple brings in $140,000 a year. They pay their taxes. One spouse passes away. The household income drops to $105,000 because they lose the smaller Social Security check. You'd think taxes would go down, right? Wrong. Because the survivor is now a single filer, their taxes actually go up by $4,000. Think about that. The worst thing of your life happens. You have $35,000 less to live on, but you are writing a bigger check to the IRS. This is the widow's penalty. Why does this happen? In 2025, the standard deduction for married couples is over $31,000. For a single person, it drops to roughly $15,750. The tax brackets compress. The 22% bracket that used to go up to $200,000 now stops at roughly $100,000. And your RMDs, the forced withdrawals from your retirement accounts, they don't shrink. So you have the same taxable investment income crammed into a tax bracket that is half the size. Your traditional financial advisor isn't talking about that. They are just happy to take their fee. One way we can look at how this could be solved is to consider Roth conversion. Roth conversions are 50-50 whether they make sense for people or not. We run the numbers for people. We don't just look at the numbers on the page, we look at your life situation as well. You have to go deeper when you look at Roth conversions. Sometimes they make sense on paper, but practically they don't. Do not leave your spouse with a tax bomb. That isn't a legacy, that's a liability. You deserve to know they are protected. If you are married, you need to stress test your plan for the widow's penalty. Click the link below to get some time on my schedule to get an analysis run for yourselves.